Welcome to the deep dive, everybody.
Yeah.
We're going to be tackling something pretty complex today, the Income Tax Bill 2025.
Big one.
It's a big one. We know legal documents, they can be dense and complicated,
Yeah.
but we're here to break it down for you so you don't have to wade through all that jargon.
Yeah, we'll pull out the key points and make it clear what this all means for you.
Absolutely.
Yeah.
So this bill, it's massive, but let's start with a few chapters that really jumped out at us. Chapter 4D, I think, is where it gets really interesting,
Yeah.
especially for, anyone who's running their own business. This chapter focuses on defining income from profits and gains of business or profession.
Yeah, and it's basically setting the foundation for how businesses are going to be taxed under this new bill. Super important because it has a direct impact on, what deductions you can claim, what expenses you can write off, and ultimately your bottom line.
Right. Makes sense. Then we've got Chapter 5, which deals with income from other sources. So that's like the catch-all for everything that's not strictly business income, right?
Exactly.
And then, just to make sure everyone's playing by the rules, we have Chapter 7, which focuses on the general anti-avoidance rule.
Right. Don't even try to get clever with loopholes.
It's like the bill is saying, we're watching you.
Yeah, exactly. And it's especially relevant now because tax avoidance schemes, they're getting so much more sophisticated.
Oh, yeah.
This chapter is giving authorities more power to really scrutinize arrangements that seem designed just to lower tax liability, even if they technically follow the rules.
Yeah, that's a pretty big change. It seems like they're trying to close those loopholes for good. But before we get into the specifics, let's define a few key terms. The bill uses a lot of jargon like assessee, assessing officer, permanent establishment. It's almost like a whole new language.
Yeah, it can definitely feel that way.
Yeah.
But understanding these terms, it's crucial because they're the foundation of the entire bill. Like, for instance, permanent establishment. It may sound technical, but it can have real-world consequences, especially in our globalized work environment.
Yeah, can you give us an example?
Sure. Let's say you're a freelance graphic designer working remotely for a company in the US. You live in India, but you spend a few months each year in, say, Bali for inspiration.
Okay, yeah.
If you spend enough time in Bali and have a dedicated workspace there, well, you might trigger the permanent establishment rule,
Oh, really?
which means that some of your income could be taxed in Bali.
Wow. That's a great example. So location really matters. And another term that gets thrown around a lot is tax year. Is that just the same as the calendar year?
Not quite. The bill defines tax year as the 12-month period that starts on April 1st, which
Right.
aligns with India's financial year.
Okay, gotcha. So keep that in mind when you're looking at your income and expenses. It's not January to December, it's April to March. Okay, so we've got our basic definitions. Now let's move on to residency for tax purposes. I always thought that was pretty straightforward, but this bill makes it seem more complicated.
Yeah, it's not always as black and white as it seems. The bill determines residency based on the number of days you spend in India, but there are exemptions for certain situations, like Indian citizens working abroad on Indian ships or for companies outside of India.
Right. Makes sense they're earning their income elsewhere. But here's where it gets really interesting. The bill also says that if you hold assets or financial interests abroad, A&D earns significant income, more than 15 lakh rupees from those foreign sources.
Mm-hmm.
You're also considered a resident for tax purposes.
Right. And it highlights how complex international taxation has become. Income can be earned from anywhere these days.
Mhm.
So it's essentially saying that even if you're not physically present in India, your financial ties to the country can make you a resident for tax purposes.
Wow. That's something to think about.
Yeah.
So even if you're living the, digital nomad dream, you might still have to answer to the Indian taxman.
That's right. And it's not just your individual income that they're looking at. In some cases, they can also include your spouse's and minor child's income.
Oh, wow. So they're really looking at the whole family unit here.
Yeah.
What happens if someone's income is included in someone else's tax calculations? Are they still liable for it separately?
That's a good question. And yeah, the bill does have provisions for those situations, ensuring that the right amount of tax is paid without double taxing anyone. It can get a bit complex, though.
Right, of course. They've got to cover all the bases.
Sure.
Okay, so we've talked about residency and how income is defined. Let's get to the part everyone loves to talk about.
Yeah.
Capital gains. This is where things get really interesting.
Absolutely.
Right.
The bill's making some significant changes to how profits from selling capital assets are taxed. And understanding the difference between short-term and long-term gains is crucial here.
Yeah, for sure. Because they have different tax implications, right?
Yeah.
So how does the bill define those terms? What's the cutoff?
Well, generally, if you hold a capital asset for more than 24 months, it's considered a long-term gain. But there are specific rules for calculating the holding period, with certain periods excluded.
Okay, so it's not just a simple 24-month count on the calendar.
Yeah.
And I'm guessing how you determine the cost of acquisition for those assets is important too, right?
Yeah.
Especially since this bill has specific provisions for assets acquired before April 1st, 2001.
Absolutely. The cost of acquisition is the starting point for calculating your capital gains, and for older assets, there are special rules for figuring out that cost. It can get a little tricky.
Yeah, sounds like it. Now, you mentioned something earlier that really piqued my interest. You said that if the sale consideration for land or a building is less than the stamp duty value is considered the full value for tax purposes.
Hmm.
Can you explain that in simpler terms?
Sure. Imagine you sell a plot of land for, say, 50 lakh rupees.
Right.
But the stamp duty value for that land is 60 lakh.
Okay.
Even though you only got 50 lakh, you'll be taxed as if you got 60.
Wow, that's something to keep in mind when dealing with property. Okay, we've covered a lot about individual income and investments. Let's shift gears and talk about businesses. This bill has a lot to say about deductions for businesses, including things like spending on scientific research and depreciation on assets.
Yeah, it does. And understanding the specifics of these deductions is super important. For example, you can claim a deduction for capital expenditure on scientific research, but not for buying land, for instance. And for depreciation, the bill sets out detailed rules for calculating the written down value of assets.
It seems like they're trying to encourage investment in research and development, which is great for innovation. But what about businesses that are, let's say, trying to minimize their tax liability through creative accounting? Does the bill address that?
Oh, absolutely. That's where the impermissible avoidance arrangements come in.
Yeah.
Essentially, if the main purpose of an arrangement is just to get a tax benefit and it lacks any real commercial substance, the tax authorities can just disregard it.
So no more loopholes.
Well, not if they catch you. This provision gives authorities more power to scrutinize transactions that seem designed primarily for tax avoidance.
Makes sense. It's all about paying your fair share. Now, there was this one section that really surprised me. The tonnage tax scheme. What is
Oh.
that all about?
It's a unique way of taxing companies in the shipping industry. So, companies that operate qualifying ships have their income calculated based on the ship's tonnage, not their actual profits.
Wait, so a bigger ship means more taxes, even if it's not making a lot of money.
Exactly. It's a completely different approach, and it shows how specific industries might have tailored tax provisions. There are rules, of course, for how they compute this tonnage income and which ships actually qualify for the scheme.
Okay, that's fascinating. So we've explored residency, income from various sources, capital gains, and even touching on business taxation. But there's one last, slightly less glamorous topic we need to cover. Penalties and offenses. Nobody likes to think about it, but it's important to understand the consequences of not complying.
Absolutely. The bill outlines penalties for various offenses, like not filing returns, tax evasion, even helping someone else file a false return. And these penalties aren't just for individuals either. Companies and Hindu undivided families can be held accountable too.
Right, because everyone needs to play by the rules. And in some cases, the bill presumes you had a culpable mental state, meaning they assume you did it intentionally, which makes things even more serious, right?
Yes, exactly. And this raises some questions. What are the implications of this presumption for businesses and individuals? It's something to think about, especially when structuring business arrangements or making financial decisions. They're not just looking at the actions themselves, but also the intent behind them.
That's a great point. This bill really tries to create a system that is both fair and really difficult to manipulate. We've covered a lot in this first part of our deep dive, but there's still so much more to explore. In part two, we'll dig deeper into how this bill impacts specific situations and income types. So stay tuned because we're just getting started.
Yeah, we'll be back with more insights and analysis to help you navigate this new tax landscape. Welcome back to our deep dive
Okay,
into the Income Tax Bill 2025.
we've covered a lot of ground already, but I'm really curious about how this bill impacts income that's earned by people who aren't residents of India. Like, it feels like a whole other layer of complexity.
Yeah, it does add another layer, but the bill's pretty clear about when a non-resident's income is actually considered taxable in India. For instance, royalty income that a non-resident receives from the Indian government or a resident, that's taxed here.
Okay, so even if you're not living in India, certain types of income earned here are still subject to taxation. What about if a non-resident earns income from a resident but for a project that's based, like, outside of India? Would that be taxed here too?
That's a great question, and the bill addresses those nuances. So, in the case you described, where the royalty is for a business or profession that's carried on outside India by the resident payer, it wouldn't be taxed here.
Okay, that makes sense. So location really plays a big role in determining tax liability for non-residents. What about the concept of a permanent establishment that we discussed earlier? Does that apply to non-residents as well?
Absolutely. If a non-resident has a permanent establishment in India, the profits that are linked to that establishment are taxed here. It goes back to that idea of having a significant presence in the country.
So it's not just where the income is earned, but also where the business activity is taking place. Okay, I think we've covered the non-resident piece pretty well. Let's move on to something that affects a lot of us. Salaries. I'm curious to see how the bill tackles this common form of income.
One thing that really stood out to me is how the bill specifically says that any salary due to or received by a partner from their firm isn't considered salary under this section.
Oh, interesting. So they're really being specific about what qualifies as salary for tax purposes. What exactly falls under that definition then?
Well, they give a pretty broad definition, actually. It includes wages, annuity, pension, gratuity, fees, commissions, perquisites, profits in lieu of salary, advance salary, and even leave encashment.
Wow, that's quite a list. So it covers pretty much any type of compensation an employee might receive.
Yeah, pretty much.
And I'm guessing they have different rules for how each of those components is taxed, right?
You got it. The bill lists various allowances that are fully taxable, partially taxable, or fully exempt. For example, allowances to cover personal expenses at the place of work or residence, or to compensate for increased living costs, those are fully taxable.
Okay, so if your employer gives you an allowance for housing or to, offset the high cost of living in a certain city, that's considered taxable income. What about travel allowances or reimbursements for work-related expenses?
Those are handled differently. Travel concessions or allowances that are specifically for covering expenses and that are completely necessary and exclusively incurred for work, those are exempt.
Okay, that makes sense. It seems fair to exempt those kinds of allowances. Now, what about those perks? Things like a company car or rent-free accommodation. How does the bill handle those?
The bill actually goes into a lot of detail about these perquisites. They even outline how to put a value on things like rent-free accommodation or employer-provided vehicles. It's clear they want to make sure these benefits are accounted for properly in your taxable income.
It's fascinating how they're trying to capture all these different aspects of employee compensation. It shows how comprehensive this bill is. Is there anything else about the salary section that you thought was worth noting?
There's a part about profits in lieu of salary that caught my attention. This includes things like payments you receive when your employment ends or if you take voluntary retirement.
Oh, that's a big one. I'm sure a lot of people are curious about how those payments are taxed.
This section outlines exactly how to calculate the taxable portion of those payments. And there are specific exemptions for things like compensation received under voluntary retirement schemes. It's definitely something to consider if you're thinking about those options.
It sounds like this bill has something for everyone, even those who think they have a pretty good handle on their finances. Of course, no discussion about income tax would be complete without talking about deductions. I'm curious to see what this bill has to say about them.
Yeah, for sure. A big portion of the bill is dedicated to outlining the various deductions you're allowed to take when calculating your taxable income. This includes familiar things like the entertainment allowance, contributions to provident funds, and life insurance premiums.
Right, so those are some of the common deductions many people are already using. Are there any new or unusual deductions that caught your eye?
Well, I found it interesting how they differentiate between a self-occupied property and a let-out property when it comes to deducting rent paid.
Right, a lot of people are renting or have mortgages, so this is pretty relevant. Can you break down those differences for us?
Sure. For a self-occupied property, you can deduct the interest you pay on your home loan, but only up to a certain limit. But for a let-out property, you can deduct the entire amount of interest paid, no matter how much it is.
So it seems like they're encouraging people to buy homes while also acknowledging the financial realities of those who are renting out their properties. Are there any other deductions related to business or professional expenses that you think are worth mentioning?
The bill allows you to deduct certain expenses you incur for your business or profession, things like depreciation on assets, repairs, and insurance premiums. Business owners should really take a close look at these provisions to make sure they're maximizing their deductions.
Yeah, every rupee you save on taxes is a rupee you can put back into your business. But I'm guessing there are also some limits on what can be deducted, right? They can't just let you write off everything.
Of course not. The bill clearly states that you can't deduct personal expenses, capital expenditure, and payments where you haven't deducted tax at source. They're drawing a clear line between what are legitimate business expenses and what are not.
That makes sense. It's all about creating a system that's fair and prevents people from taking advantage. Speaking of fairness and transparency, this bill has a whole section on disclosure of information. What's the purpose of that?
This part is really important in today's world where money is constantly moving across borders. The bill requires certain entities, like banks and financial institutions, to report specific financial transactions and reportable accounts.
So they're basically trying to make things more transparent and make it harder to hide income or assets in other countries?
Exactly. It's a way to fight tax evasion and make sure that everyone's paying their fair share, regardless of where their money is.
That's really important in our globalized world. Are there any specific rules related to international taxation that stand out to you?
The bill includes provisions on international taxation, including things like transfer pricing regulations and reporting rules for cross-border transactions. One thing that stood out to me was the master file requirement for multinational companies.
Master file. That sounds pretty serious. What exactly is it and why do they need it?
It's basically a file that these companies have to maintain with standardized information about their global operations. This includes their organizational structure, business activities, and transfer pricing policies. It's all about giving the tax authorities a complete picture of the company's operations so they can assess any potential risks.
So it's like a detailed map of their global footprint and all their financial dealings.
Yep, exactly. It's meant to increase transparency and prevent companies from shifting their profits to countries with lower taxes.
I can see why that would be important to prevent tax avoidance on a global scale.
Absolutely. These international tax provisions highlight the growing complexity of the global economy and how we need strong rules to ensure fairness and prevent abuse.
This deep dive has been really eye-opening. It's amazing how detailed and complex this bill is. We've seen how it affects non-residents, delved into the complexities of salary and perks, and even touched on the importance of information sharing in today's world. This Income Tax Bill 2025, it's a real game changer, impacting both individuals and businesses.
Yeah, it is. And there's even more to come.
Welcome back to the deep dive. We're in the home stretch now of our exploration of the Income Tax Bill 2025. We've uncovered so much already, but I'm really interested to see how this bill impacts specific sectors. It seems like certain industries might have special considerations.
You're right. The bill does have specific sections for different sectors, and one that I found interesting was about cooperative banks.
Oh, okay.
There are some provisions regarding reorganizations of these banks and how they affect deduction.
Cooperative banks are so important in many communities. Makes sense that the bill would address them specifically. So what kind of reorganizations are we talking about here?
Well, one scenario is amalgamation. That's when one or more cooperative banks merge with another one. The bill allows the successor bank to claim deductions for any accumulated losses and unabsorbed depreciation from the predecessor banks.
So if a struggling cooperative bank merges with a successful one, those past losses can be used to offset the combined income for tax purposes.
Exactly.
That's a good way to provide some relief during these mergers.
Yeah, it recognizes the unique nature of cooperative banks and helps them go through these transitions without being held back by past financial issues.
That's a great example of how the bill really gets into the specifics of different industries. Are there other industries that get this kind of attention?
Yeah, another area with specific provisions is scientific research. The bill outlines deductions for both capital and revenue expenditures in this field.
That's so important for encouraging innovation and advancements in technology. So if a company invests in, say, building a new research facility or buying specialized equipment, those costs can be deducted.
That's right, but the research has to be directly connected to the company's business. It's basically a way to motivate companies to invest in research and development, which helps the whole economy.
Yeah, that makes sense. It's great that they're encouraging that. Now, thinking about the long term, infrastructure is another crucial area. Does the bill address this at all?
It does. The bill defines what an infrastructure capital fund is and outlines the tax implications for investing in them.
I'm guessing these funds are for those huge long-term projects like roads, bridges, power plants, the stuff that's essential for development.
You got it. And those projects need a lot of investment and take a long time to complete. So these tax incentives can attract investors and make those projects more feasible.
It's like they're using the tax code to encourage investment in things that will benefit everyone in the future.
Yeah.
I also noticed something about a site restoration fund. What's that?
This is an interesting one. I think it shows that we're becoming more aware of the environment. So with this site restoration fund, companies can deduct contributions they make to it. And this fund is meant to cover the cost of restoring a site after a project is finished, like mining or construction.
So instead of just leaving a mess behind, companies are encouraged to clean up after themselves.
Exactly.
That's a good thing to see.
Yeah, it encourages responsible environmental practices and makes companies think about the long-term effects of their projects.
Okay, so we've seen how this bill addresses specific sectors with tailored rules and incentives. I'm also interested in the bigger changes it brings to how taxes are administered. What are some key things we can expect?
One of the biggest changes is faceless assessment.
Faceless assessment. That sounds kind of mysterious. What does it actually mean?
It basically means that taxpayers and tax officials won't have to interact in person anymore. The whole process will be handled electronically.
So no more trips to the tax office. That's a big step towards modernizing things.
It is, and it's not just about convenience. It's about reducing the potential for bias and making things more transparent.
That's a really good thing. Are there any other administrative changes that stand out?
Another important one is the new dispute resolution panel.
Right, because there are always going to be disagreements, even if everyone's trying their best. How will this panel work?
It will be made up of tax experts, and it's designed to be a faster, more cost-effective way to resolve disputes. It's meant to take some pressure off the traditional appeal system, which can be a long and expensive process for everyone.
So it's like a simpler way to resolve disagreements.
Yeah.
That makes a lot of sense. Wow, we've covered so much ground in this deep dive. From specific details to the larger changes, it's clear this Income Tax Bill 2025 is a big deal for individuals, businesses, and the whole tax system. Any final thoughts or advice for our listeners as we wrap up?
I would say approach this mill with curiosity and be proactive. Don't let all the jargon and information scare you. Start by understanding the basics and then focus on the sections that relate to you or your business.
Great advice. This deep dive has been a great starting point, but the bill is a big document with a lot of details.
Yeah, and the world of taxes is constantly changing, so it's important to stay informed to make smart financial decisions. Don't hesitate to get advice from tax professionals if you need to.
That's a good point. Sometimes having an expert by your side can really help you make sense of these things. Well, that brings us to the end of our deep dive into the Income Tax Bill 2025. We hope you found this exploration helpful in understanding this important new law.
Until next time, happy navigating the world of taxes.